Hi guys, welcome back. Today we are going to talk about financial statement analysis. To be specific, we will deal with liquidity ratios. Quick review. Financial statement analysis is the process of examining the financial statements to evaluate the financial position and performance of an entity for decision-making purposes. Financial statement analysis can come in the form of horizontal analysis and vertical analysis, which we have discussed in the previous video. For this video, we are going to proceed to ratio analysis. Ratio analysis is a technique where different line items from the financial statements are being compared, including those across financial statements. This is to be contrasted with vertical analysis, where all comparisons are made only within the same financial statement. Balance sheet to balance sheet, income statement to income statement item. But this time, in ratio analysis, mixing of financial statements do happen. We have stated in the previous videos that liquidity ratios measure the company's ability to meet short-term obligations. Solvency ratios expresses the ability of the company to meet long-term obligations and survive in the long run. Activity ratios, on the other hand, quantify the efficiency of an entity in utilizing its resources. Profitability ratios, on the other hand, tells us whether the entity is earning. We are going to focus our attention in this video in the liquidity ratios. What are liquidity ratios? To understand, we must first define the word liquidity. Liquidity simply means cash convertibility, the ability of something to be converted into cash. That is what we mean by liquidity. Why are we interested in liquidity in the context of our discussion? Again, liquidity ratios measure the ability of an entity to meet short-term obligations when they come due. As such, being able to convert assets into cash will give the company this ability, considering short-term obligations may be due within a month or quarter. That is, when we measure liquidity, we are basically measuring the ability of the company to pay current liabilities. Common liquidity ratios are as follows. We have working capital, which is the difference between current assets and current liabilities. Current ratio, which is current assets divided by current liabilities. Acid test ratio, which is basically quick assets over current liabilities. And cash ratio, which is cash in a broader sense, divided by current liabilities. Again, the intention of these ratios is for us to measure the ability of an entity to meet short-term obligations when they come due. Remember, when we are going to pay current liabilities, our source of payment will definitely be cash. And we know that short-term assets can be converted to cash. That is the reason why the higher the liquidity ratios, the more liquid the company is. As you have noted, the numerator are the asset items, while current liabilities are in the denominator. Let us go to the following case to demonstrate how this is measured. EDK Enterprise showed the following items in its balance sheet for 31 December 2020. Cash, marketable securities, accounts receivable, inventories, prepaid expenses. These are asset items. Accounts payable, accrued liabilities, income tax payable, short-term notes payable. These are current liabilities. At this point, we are going to find the current liabilities of PDK Enterprise. Accounts payable, 14,000. Accrued liabilities, 11,000. Income tax payable, 18,000. Short-term notes payable, 21,000. This will give us a total current liabilities of 64,000. Remember, current liabilities will be needed in all of the liquidity ratios that we have mentioned. How about the numerator? Let us proceed to the asset side. Remember that the asset includes cash, 40,000 pesos, marketable securities, 15,000 pesos, accounts receivable, 30,000, inventories, 25,000, prepaid expenses, 20,000 pesos. Generally speaking, the items mentioned are current items. As such, we just have to add them up in order to arrive at the current assets. You would have a total of 130,000 pesos. Now, one of the ratios would require the calculation of quick assets. What are quick assets? Well, quick assets would include cash, marketable securities, and accounts receivable. Why are inventories and prepaid expenses excluded? Well, when we are going to convert them into cash, they aren't quick enough. That is why they aren't included in the quick assets. So the sum of our quick assets would be 85,000 pesos. What about the cash in a broader sense? In a broader sense, cash would include marketable securities. Why? Because marketable securities are readily convertible into cash. And therefore, it would be safe to say that they are as good as cash. Cash in a broader sense, we would have 55,000 pesos. Let us now calculate the liquidity ratios. Working capital, difference between current assets and current liabilities. Current assets is 130,000. Current liabilities is 64,000 pesos. Working capital is therefore 66,000 pesos. Now, what's the problem with measuring the working capital? Well, I think you get the point of why we are calculating the working capital. We want to know whether there are enough current assets to meet the current liabilities should they become due. So what's wrong with the working capital calculation? Well, if you're going to look at the working capital amount alone, that is 66,000 pesos, you cannot really deduce what the liquidity of the company looks like. Remember that 66,000 is the difference between 130,000 and 64,000. But it can also mean the difference between 1,066,000 and 1 million pesos. In the former, 66,000 may be a material amount, but in the latter, it looks insignificant. This is the reason why we may want to resort to the current ratio. Expressing them in ratios would give us a clearer picture. Current ratio, we have current assets divided by current liabilities. Current assets is 130,000 pesos. Current liabilities, 64,000 pesos. we have a current ratio of 2.03. In this case, it is quite imaginable how large the current assets is relative to the current liabilities. The current assets are 2.03 times the amount of current liabilities. Again, giving us a clearer picture. But what if we are not confident that the current assets are liquid enough to meet the current liabilities? Then we can remove portions of the current assets, which takes a longer time to liquidate. This is the reason why we may also calculate the acid test ratio alternatively. This is equal to quick assets divided by the current liabilities. Remember that the quick assets exclude things like inventory and prepaid expenses. We have calculated this to be 85,000 pesos divided by 64,000 pesos, or current liabilities. The acid test ratio, also known as the quick ratio, is 1.33. But what if we are still not confident with the quick assets? We want to see whether there's readily available cash to meet the current liabilities. So we will go to the most stringent liquidity test, the cash ratio. Again, cash includes marketable securities. That's why we call this cash in a broader sense. So we would have cash in a broader sense, again including marketable securities, 55,000 pesos, divided by 64,000 pesos, the current liabilities, we would have a cash ratio of 0.86. So there you go. We were able to calculate the liquidity ratios of PDK company. Based on what we have calculated, is PDK enterprise liquid? Remember, the higher the liquidity ratios, the more liquid the entity is deemed to be. Well, actually, I don't know. Why do I not know? Well, ratios will have meaning only if there is a basis of comparison. In the case of PDK company, we should compare the liquidity ratios with some form of benchmark. For example, we should identify what industry PDK is operating. Industry standards can be set for each particular ratio. Say, for example, in a grocery, what would be our standard current ratio, acid test ratio, or cash ratio? In that way, we can have a basis for comparison. Also, we can compare PDK Enterprises ratio with its past or historical ratios. We can see the development of the working capital, the current ratio, and so on. So in answering the question whether an entity is liquid, the liquidity ratios should be compared in reference to some benchmark, such as an industry standard, knowing where the company is operating, or historical ratios, its past ratios. One more thing, it is important to take note that too much of a good thing is a bad thing. Remember that we want liquidity ratios to be higher to deem the company more liquid. But what if your current ratio is 100 times? Your cash ratio is 80 times. I do not think that that would be a healthy ratio. To give you some perspective, imagine that you're operating a small sari-sari store. Would it be wise to keep a petty cash of 1 million pesos? Well, it will make the sari-sari store more liquid. However, that also signifies inefficiency. You're not putting into good use your money. The 1 million pesos can actually be used to operate a second, a third, or a fourth store. Again, too much of a good thing is a bad thing. That is the reason why liquidity ratios should be high but not too high. The next video, we are going to talk about solvency ratios. In the meantime, like, share, and subscribe.
Like, share, and subscribe.